Hello, Warriors. Alexander, Mary, how are you? And we also have Sinatra in the house and Paul. Morning to you, Paul.
Good.
Probably looking to buy the pound. And who's that? Came in?
Good early morning, Dale. May the 4th be with you and the FOMC as well.
Okay, I think the force is with me, or I probably wouldn't still be around. So let's take a look at what's happening here on this quiet pre-Fed. You know, everyone's so worried about this came in. I'm having a feeling that maybe it's going to be a non-event.
A wet sprocket.
Yeah, you know, and then maybe the inflation number is more important that I believe we get this morning.
It could be. Let's say what's going to be important in this particular FOMC. We all know, and all the analysts are agreeing that we are going to get a 50 BP hike.
Right.
So what's the more important and what probably will cause or help the viability of any move post decision and post press conference is
QT.
To know how quantitative tightening will go and what kind of rate path they will observe.
Right. Okay. All
So,
right.
QT is the new QE.
Yeah,
right?
it's yeah.
What do you say, Blake?
QT is the new QE. I mean, you know, that's
You're very far away from the microphone, by the way, Blake. We don't hear you too well.
Oh, can you? Does it sound horrible?
No.
Hey, it's better now. It's better now.
Oh, it's better now.
Just a little low.
No, what I was saying is
Much
QT is the new QE. I mean, as far as like catchphrases, right?
Yeah.
Everybody's going to be focused on, you know, what kind of tightening are we doing, you know, and what's the dollar amount versus used to be, you know, how much QE is the Fed going to be, you know, putting into the market. So it's funny how we are like actually on the flip side of the coin now, right?
Yeah. You know,
so,
last week I put on some longs in the semis when it got to this wedge line, and last week and even when the S&Ps were making new lows, the semis were not. So you know, of course, you know, my bias is that whatever they're going to say could be you know, not bullish, but not too hawkish, and if they do, I'm wrong under the low here. And then the other thing I did was a cannabis stock, because you guys know what my inclinations are, and this one's an American one. A lot of people buy Canadians like Tilray and this one, but this is a U.S. cannabis stock, and you know, while the market was under pressure, you know, that old saying, when the whole board is red, buy what's green. It's so simple, but you know, it's like it's relative strength, you know, or when the whole board is green, sell what's red.
You know, Dale. Okay, this has nothing to do with the Fed at all. But it's interesting that you brought this up, because I think this is you would really like the interview I did with a gentleman yesterday, and his name is Tommy Lackey. He's a portfolio manager.
Oh yeah, I think
Volatility Capital. Yeah, he has a whole, like, it's his power investing site. It's all relative strength stocks. You know, like that's all it is really just like a big, you know, relative strength type of thing. Anyway, his interview will be out a little bit later today, but the reason why I bring that up is because that's exactly what he does. And he was like, yeah, you know, when the market's bounced, he picked up, or you know, I don't know if he picked up, rather he just was really recognizing all the stocks that had been beaten down were the ones that bounced back aggressively early this week. But anyway, that's interesting you point that out. And I know you're trading cannabis stocks because you like to get stoned, but you know, I mean,
so I mean, it's not, you know,
why not?
You know, some people like alcohol.
So hey,
Okay.
Kman, and I heard Stelios there for a second ago. I think Stel, you're here, right?
I am here, of course.
Okay. So let me ask you guys this. I mean, is the Fed going to be as hawkish as the market really is expecting? I mean, that's the key, right?
Well,
Yeah.
I think as we were saying earlier and on prior webinars, and Stel has already said exactly the same. It's too early for them not to go hawkish,
Yeah.
and I share that view. So they will stay hawkish because they are just starting the hiking and the QT. In my opinion, they will stay hawkish. Powell is not going to rule anything out, although I don't think he will be a voter pro 75 BPs. I don't think so. I think we might have several meetings where we have 50 BPs. But
is he going to be
too early for them to leave?
Is he going to be hawkish enough to satisfy the hawks? I mean, is he going to really like be so hawkish where the markets go, holy cow, here we go, the Fed's gonna, here we're gonna see a Paul Volcker style Jay Powell, and is the market really going to feel that way?
If he wants to break the market, he certainly has a chance to do it today. Look at where it's hanging, like
absolutely,
at your neckline.
100%.
So
100%.
We'll see if he's S&P dependent anymore at all. Remember on the way up during QE, Peter would say that he's not data dependent, he's S&P dependent, Peter Bookvar. So we'll see. I mean, if he wants to break the market, no better time than when it's hanging by a thread.
Well, I don't think he wants to break the market. And I don't think any Fed governors want to specifically. As a matter of fact, probably most oppositely, he's very keen on, how closely we are trading to some pretty key levels, I think, in the market. I'm sure that not only him, other, Fed governors are very cognizant of where we're at currently. So I guess the question is, is he going to be super hawkish? Because he knows if he comes out swinging, with the hawks, that the risk is some downside risk in the markets. And so that's the key, because I'm in the camp that, I agree with you, Kman. He is going to be hawkish. We're just starting this campaign. The Fed is just starting to raise rates, but he's going to, I think he's still going to be a little bit more on the dovish side because of, the China lockdowns, COVID, a little hesitant about growth, watching GDP. I mean, he's gonna be a little bit more hesitant, and as a result, I think stocks are going to recover today.
It could be the stocks recover because QT will likely only start in June. I mean, they can announce the program now, right? But they may say we start to take the liquidity away from June. It's possible. By the way, there should be
a good point.
An additional statement coming out. The planning of the QT and the sales of MBSs and treasuries should be coming out on the side. So we have to watch out for that as well. But I don't think that he has to be more hawkish than what he has been. I think he telegraphed everything very, very clearly when even during the meeting they had joint meeting, the PIIE stuff that he had with Lagarde. I think it's just. So
you guys think he's going to be like this?
Pretty much.
All right.
So Stelios, we haven't heard from you. What are you thinking?
Well, I unfortunately going to repeat what I said yesterday, more or less. The question is, does he have reasons? Do the Fed have reasons to be more hawkish than they have been so far? I don't think they do. But on the other hand, I don't think they want to show weakness, let's say, yet. So unfortunately, I think it's going to be, they're going to deliver what the market's expecting, no more, no less, and we wait for the next meeting. So, I don't think we're going to see any major surprises. If you put a gun to my head and ask me, which way do you think he's more likely to be, even with inflation rising, I think that the pressure is going to start adding for them to maybe take it a little bit more slowly. So, and this is because, well, growth printed negative. Yes, it's only one print, so they're not going to put too much weight on this yet. But also, B, stocks 20% below their highs. And like Dale very correctly said, they don't want to push it over the cliff. And they want, ideally, they want to engineer a soft landing while having equities relatively not unscathed, but coming down at a nice gradual pace, which is very difficult to engineer, I have to say. So I think, unfortunately, they're going to deliver what the market expects, nothing more, nothing less, at least not yet. So I'm going to be boring and say that. Sorry.
Yeah, you are boring. I
am boring.
Married to you.
Yeah, well, I have one ex-wife already, right? So that tells you something.
Hey, Dale, I'm going to take over. I've got one thing, and I'm going to ask you guys. I'm going to ask you guys this: what is the one thing you're looking at that is going to tell you, green light, red light? Should I be buying or should I be selling risk? Let me go with that. And okay. I'm gonna give you guys mine, and then you guys can give me your follow up here. Now, I know everybody's like, well, what's the euro doing? And I think we could pretty safely say, well, if the euro hits new lows, everybody's gonna be long dollars. We know that's going to be a obviously a very hawkish response by the Fed, and stocks are going to probably come down. But that's not the asset I'm actually looking at. I mean, again, we can go to the dollar index and say, well, the dollar index is there. The dollar index is, we're at the 2017 highs right here and a spike high. So if we break out, we know that this is going a lot higher, the dollar. And I think a lot of people are standing in front of the dollar right now. And a lot of people don't want to see that happen because, that's it. But that's not the currency I'm looking at today. The currency I'm specifically looking at, and Kman, you probably, empathize with me here, is I'm looking at the dollar Mexican peso. This is probably the best risk barometer in the market. So if you guys are currency traders, or even if you're not currency traders, if you're just, somebody who trades the S&P, for example, I'd be watching the dollar Mexican peso. This has been a currency. The Mexican peso has been a currency that's been acting well despite the sell-off that we've had in risk. So what I'm looking for today is if the dollar Mexican peso trades squarely below the 2020 level, maybe closer to 2015, that's a good indication that stocks are going to be bouncing back. And I have to mention this. I know I mentioned it yesterday, but I'm going to mention it again right now. If you look at the S&P, we are, and here, let's go to the other chart that you guys know this chart much better than the other one. The other one, I get a little bit into the, nitty gritty as far as the intraday analysis goes. But, when you're talking about the S&P like on a longer term scale, this is the S&P, this is the long-term head and shoulder pattern we've been looking at. But if you notice this right shoulder, time-wise, we have really several more weeks of building out the right shoulder if we wanted to be symmetrical. So the reason why I say that is because there's scope for stocks to recover from here, especially after having a false breakdown on Monday. So if we see the dollar Mexican peso trading squarely below 2020 today, post FOMC, that is a good indication to me that we need to be buying stocks. So that's what I'm looking at. How about you guys? Kman, what are you looking at? What
hey guys.
Is, huh? What?
It's Gregor here.
I don't want to hear from Gregor. I didn't even ask.
Yeah, I know.
I know. I didn't even say, hey, Gregor, what are you thinking? No, I was actually talking to Kman. Just kidding, buddy. Good to see you. Good to hear from you.
Hey, Wizard.
Hey, Gregor, can you give me 1 second to let Kman?
Yeah, sure.
Okay. What's up, Kman?
Well, to me, the cleanest trade, if one wants to be long dollars, is still going to be dollar yen on dips. Euro, there is there is a little uncertainty because now last night Schnabel came out and said that she would agree on a July hike by the ECB. But I still think for as long as the euro trades to start with below 106, 110 or even below 107. It's still gonna be looking, I think, as a sell-on rallies in the euro dollar as well. But I would say that if the Fed delivers just what the market says, it's the 50 BPs hike, and remains a little vague on what's to come afterwards, the initial reaction, because all those hikes are already priced in the market, right? The initial reaction could be for the dollar to retrace a little bit lower. It is very possible, but I still would be looking at the end result, like for instance in the yen, to be a buyer on dips, and I would still be looking because there is the biggest divergence between the central banks.
Yeah,
I would still be looking for dollar yen to test higher at some stage.
okay, all right, thanks. And I want to hear from Greg, but I just want to say this. I'm going to throw this out there. You said the knee-jerk reaction, and I want to expand on that just a second, just because I think that the knee-jerk reaction is Fed raises, interest rates by 0.50%. Headline, a couple headlines might come out. Knee-jerk reaction is going to be dollar buying. Yeah. And so I'm looking at the euro here, consolidating this really tight triangle. And I want you guys to listen to this, because this is something that I'm not going to be in front of the computer today. I've got some personal things I've got to attend to, and that was unexpected as of this weekend. So I didn't, this wasn't planned for me not to be in front of the computer today. But I have something I have to handle today. But the ForexAnalytix crew is going to be in our chat rooms and everything like that. But I just want to say that I think the knee-jerk reaction could be initially dollar buying, takes the euro dollar down to the 261% extension, just below new trend lows. Just enough to push people out. Anybody who's long, get them stopped out, and then we get a reversal back to 106. I think that's the knee-jerk reaction I'm looking at. So that's what I'm thinking. But anyway, I'm glad you brought up the knee-jerk reaction. Now I hear Grega back there, since he so rudely interrupted us just a moment ago. How you doing, Grega? Good morning.
I'm almost like Steve.
You are like Steve. Oh my gosh, you did. Steve isn't here.
Poor Steve.
His space. So, how are you doing? And what do you think ahead of the FOMC?
Well, I think, as you said, this triangle on the euro dollar is pointing to the downside. I think that we will see more dollar strength, but it could be only temporary. I'm seeing some important levels on a higher degree timeframes on dollar index. So I think that this extended move is sooner or later coming to an end. But as you said yourself, maybe this current price action will just not allow for traders to be long with small stops, smaller risks. So these important events usually drive prices in both directions in very short term. So there will probably be some cleared stops, as you said, below the lows on the euro before market recovers. I clearly agree with that. Also, this appears to be like a wave 4 triangle. We know that occurs in a fourth wave, and more importantly, moves out of a triangles are final within a higher degree structure, meaning that we will see sharp drop. I should be aware that there could be a reversal coming, maybe already by the end of the week. So I think that overall we are going to see, as I said, limited weakness at new lows, but then major correction. Regarding stocks, I think that there's still a corrective pullback from January highs, and that 4,000 level is a key level for the S&P 500 and potential rally going forward.
Well, all right. So you think the 4,000 level is going to be big. So let me ask you this, based on the price action that we saw early this week, when it was, illiquid, it was May Day for a lot of European countries. The move below 4,100, that push below, did that satisfy your target then? Yeah,
absolutely. You can clearly count these 5 waves down from that 4,600
from up here.
Exactly. You can clearly count there 5 waves down into that new low. So there was a perfect reversal so far. Right. As you said yourself, probably cleared some stops down there, and since we have 5 waves down, there can be a rally towards 4,300. That would be first resistance to watch.
Okay, thank you very much. And you know what? I honestly would not want to be short the market right now, not ahead of the Fed. I know if I was short risk, I'd be a little worried. So the ADP numbers just came out, and I totally I'm going to be very concerned about the jobs report on Friday. As I explained to you guys on the week ahead video, I think jobs matter now. Jobs matter now, not because, are we going to continue, or are we creating 1 million jobs? That's not the question now. The question now is, do we start to see signs of the economy showing signs of weakness in a higher inflationary environment? That's why I think the jobs market is going to start mattering moving forward. And that's why, we've been very nonchalant about the NFP for in recent months, because everybody's so focused on inflation. And Charles said, yeah, job growth is gradually slowing. Yeah, that's why these types of numbers are numbers that are going to start getting people's attention. When you start, if we have jobs data that starts to show hesitation and maybe even, go into some negative numbers in the coming months, that's really, really going to affect, traders and the markets moving forward. So that's why we really want to be focused on NFP.
There also, Blake, was a big number of resignations again in March. And the stat is that now, because, the great resignation continues.
Yeah.
And that there are 2 jobs for every unemployed guy.
We resigned Stelios, and he keeps showing up at this damn webinar. I don't even know why the heck he keeps coming up here. We resigned him. Right, Stel?
Yeah. So I don't know how you figure out the employment situation with everyone quitting. It's not like they're looking for jobs. The main reason was they're jealous of us. They want to have remote work. They don't want to go back to the office.
They're all trading crypto, Dale. They're all trading crypto.
Probably.
They are. Everybody's buying Dogecoin still. That's
right.
That's the thing. So let me Dale, I wanted to bring this up just because you're a really good friend of him. Do you know who was targeting below 4,100 for the last several weeks?
Yeah, Jim.
Yeah, Jim Welsh. For those of you that don't know Jim Welsh from Macrotides, he was targeting a move below 4,100, and he's looking for a rally to all-time highs from here. And I've been skeptical. He's been saying this for like weeks, and I'm like, oh, okay, come on, really? I'm like, we're gonna push to new lows below 4,100, and we're gonna rally to new all-time highs. And
I think initially he thought we'd go 38.50, so he has said that was enough. What we had Monday now. He
in the recent weeks he's been saying 4,100, like just below 4,100, and I don't know if that was low enough to satisfy him, but I'll tell you what, it was eerily crazy when it happened on Monday. I'm like, nah. And then we reversed. I'm like, you know what I mean? So, we'll see. I still don't believe we're going to all-time highs, and, call me crazy, but I just think when the Fed's, removing liquidity from the market with quantitative tightening, right? Not QE, it's QT. With QT, it's going to be a little bit more difficult for stocks to surge to new all-time highs. Unless, let's say the Russia-Ukraine conflict was over, would that spike us to new all-time highs, even if it was just momentarily? What do you guys think about that? I mean, it's possible, right?
I personally think we're going to see new all-time highs when central banks do a 180-degree turn and start adding more liquidity, which I don't think is closer than people think, but it's not coming just yet.
So I was going to say, you think that's entirely possible? Like you think the Fed and other central banks are going to buckle to the pressures of equity markets. Doesn't matter if you're looking at the S&P or you're looking at the Spanish markets or French markets, German markets, whoever you're looking at.
It's not just equity markets. I think because we had zero rates and QE for so long, the leverage and the sheer amount of debt is historically high levels. I mean, look at student debt, house, property debt, everything that has been just growing and growing and growing. That as rates rise, as mortgage rates rise, and everything, that will have to correct. And I think if the central banks just go at it full speed ahead, it's going to correct in a pretty big way. And the central banks and the governments you can be sure that they're going to be very, very sensitive to that. So
okay,
Biden wants to pay off student debt. Yeah.
Well, let's talk a little bit about talk a little bit about the bond market here. I don't know if you guys saw my chart of the day yesterday. I actually referenced the boons. And just because I know that the 10-year is going to be very much in focus today, so is the 30-year. The U.S. Treasury market's going to be, very much in focus. But you can see we're just kind of consolidating against range lows. And I don't know if you're still here, Kman, but do you have any opinion about the bond market and where we're at? Because here I am looking at boons, and I'm looking at the German, I'm looking at the German bond market because I know they're going to move in tandem with U.S. equity or the U.S. Treasuries today. We have this 2008 low to the 2020 high. We're at the 38% retracement. We're slightly below that today because we hit a new trend low. But as you can see, technically we're diverging. So I wouldn't want to be sucked in short boons right now, looking for higher yields in the German markets. But can yields rally following the Fed today? What are your thoughts there?
Sorry.
No problem.
I think again, I said this already on prior webinars and in the rooms as well. I think what the market anticipated enough to stomach the first number of rates. If the Fed remains on exactly the same expected path, not going into 75 BPs and whatever, the rate market, in my opinion, the yield market, the bond market, priced in already enough to stomach those first couple of rates. I think the decider on this again will be how hard will they tighten, because there's already a little whispers here and there about dollar shortage because the repo liquidity is getting absorbed, of course. With rate hikes, people are not keeping as much liquidity at zero or where it might be 5 BPs at the Fed. But I think the clincher again will be quantitative tightening. How hard and how fast will they go? If they go on a slower basis than what the market is expecting now, 95 billion a month. If they go on a slower basis, I think the bond market can recover a bit. If they go on a higher one, then I think we are running into trouble. Yields will go higher, and that will really weigh on equity markets. That is my opinion, but it all depends on how fast and how much.
Yeah, well, thank you very much for your comments there. And Stelios, I'm going to say, Stelios, you've been dead wrong.
On what?
No, because we sit here and we looked at 10-year treasuries, and here's the yields that we were talking about since like 2 years ago, and you're like, man, when the 10-year reaches 2%, the market's going to poop the bed. Well, like here we are, almost at 3%. And
well, you mean it hasn't pooped the bed?
No, we haven't pooped the bed. I'm still waiting to poop the bed.
It's already 20% lower.
I want to throw in some depends.
Tell you what. Overlay the S&P on that chart, and you'll see
we'll do that for you. You know what, Stelios, I everybody here knows I love to harass.
Overlay ARC on that. Overlay ARC, huh, Stel?
So look, you can overlay ARC, and that's a whole different story. But you're right. Here's the S&P here.
That's a market too,
and you can see actually, and check this out. I mean, I'm gonna give Stelios some kudos here because I like to harass him a little bit. Actually, I like to harass him a lot because you're
every day, man.
So, but take a look here when we hit 2% in the S&P or in yields, and you can see this the stock market's like what and then we've been moving lower since then, and that's just the S&P. But yeah, you look at the NASDAQ, much different
exactly
story.
And tech stocks are much more sensitive to rates, as we all know.
Very much so, and that's why I'm going to start buying ARC today. Kidding, I'm not going to do that.
There's going to be a time when these are going to be really, really good value. But I think,
once
think
Kathy Wood's been taken out, to the graveyard and buried, it's going to be a great time to buy.
She's changing her last name to Ashes.
Yeah, I mean,
Blake, you talked about looking at dollar max. I'm looking at yields and I'm looking at 10-year US, and look at how they're, they're about to take out this high at 3% ish, and then the next level is 325, and then it's off to the races. So
okay, so that's the question. I know we're off to the races here, but do you think today is the day where we continue to extend? Because if I was trading the boons, I would be, obviously watching, going back to my original question is, do you chase yields higher here? Do you think the Fed, this is going to be the catalyst that does it?
Good question.
I don't like the divergence there.
It depends on what the Fed tells us today. So,
okay.
I don't want to trade it before the Fed.
Got it. Okay. And I'm going to say this, guys and gals, if you guys like our conversations that we have here, make sure you jump into the ForexAnalytix community, because this is what it looks like inside of our community. You can see this is, I know it's a Fed day and it's Friday, or it's Wednesday, excuse me. This is
like Friday.
I know, this is where I said good morning, everybody, at 4:07 a.m. It is 5:30. So you're talking an hour and 23 minutes ago, and you can see all the conversations that's happened over the last hour and a half. That's just in our general chat room. And that's not the Flowonomics, which is the macro chat room, the trades room, the, news and research, the Spanish chat room. And so to get involved in the ForexAnalytix community, it's only $1 for 10 days. Try it out. You get this app, you can download it on your phone. You got the chat rooms, you've got analysis, you've got, live squawk feeds, you've got updates, your, news flow from our team. And then, if you like that, jump into the trader funding program, check out that, because, if you start an assessment trying to access larger trading accounts, you actually get ForexAnalytix included, because to pass the assessment, you have to do it on a demo trading environment. What better place to have trade ideas and is a community when you're like in the ForexAnalytix community, and people are like, oh hey, I just got out of this and that, and I'm trading this and I'm getting long that and I'm short that. Having ideas is half the battle. I mean, we do analysis, but heck, I find half of my trades because other people in the chat rooms are talking about it. So jump in to ForexAnalytix. We'll see you there. And Dale, I know you have an interview, so I'm going to pass it over to you. And I want to say thank you, team. By the way, good luck to everybody that's listening in right now. If you're in the ForexAnalytix community, I will see you with Stelios and Steve in 43 minutes for the Morning Edge, which is exclusive to the ForexAnalytix subscribers, where we're going to go through all the top-down analysis for all these major instruments right here. So I'll see you guys there. Thanks, Dale. Thanks, team.
All right.
Good luck today.
Team. All right, Dream Team.
Thanks, everybody.
Hey, Stel. Thank you, buddy. And Nicholas Glinsman, welcome to F.A.C.E.
Hello, Dale. How are you?
Great to meet you, Nicholas. This is our first time.
This is our first time indeed.
Our first date? Okay. Really great to have you here. I reached out to you on Twitter, and I've been to your website. Are you here to share anything, or do you want me to do it while you and I are talking?
Well,
share your screen.
I was listening to your conversation earlier, but should I give you a bit of background on me? Would that help?
Yeah, I was going to start there. I wasn't sure if you were going to share your screen for anything yet, but
not yet.
Okay. Well, then just so.
Well, I could.
Okay.
Share screen. Let's.
Okay. Now I have to stop share. Okay. Go ahead.
Okay. So share screen. Let's do the the screen that everybody should watch, which would be, I believe, is that one. Yeah. Can you see that?
It's trying to there. Okay, we've got it. Okay,
so
you're, all that looks like you're following, a lot of yield charts. So why don't you tell us a little?
Well, because I think it's the driver. But let's start on me if that's
okay. So tell me, what were you doing and what was your first gig in the business?
Okay, first gig in the business was actually Merrill Lynch. Started in London, then ended up for a while in Australia, Hong Kong, and then went back to London. It was where I was involved in the end at Merrill Lynch, helping to set up the European government bond trading and research efforts. And then
you weren't cold calling for Merrill. Hello, Mr.
No,
huh? Okay.
More on the institutional side. And then
you were spared.
I was spared that, yes. Left Merrill Lynch to go to Salomon Brothers, where I spent a very happy 10 years. Ended up running futures and options. And subsequent to that, set up a hedge fund, which was part quant, part macro. So it was quant with a macro overlay for risk management purposes. And then what we did, I took a little sabbatical as I got pulled into an effort that was doing wireless data for market information. And we did Telerate. We developed Telerate on BlackBerry. We developed some of the Reuters efforts on BlackBerry as well. And then went back to the market, joining some of my old Salomon colleagues who'd gone via Credit Suisse to set up Brevin Howard. So I wasn't there setting it up, but I joined Brevin Howard subsequently. And with the exception of a couple of, shall we say, repos to other firms, did a couple of stints at Brevin Howard. And I have to say, really enjoyed myself. I mean, it was like it was like running money in a university. But
nice. No heat, huh?
Well, there's always heat, but it was, I've got nothing but the highest regard for my old colleagues that set it up. I mean, Alan and Trifon and also the other founding partners. And too much travel came along, and have spent time here between Brazil and Miami. I spent time at a large Brazil hedge fund consulting, and now we've set up this intelligence quarterly effort.
It's really a nice, very nice website. I'm showing it for you.
Thank you. And, so what we do, that's my column there is the ahead of the herd, which is global macro, and then we've just attached to it, which we've been doing for a while.
Wasn't that an old Wall Street Journal column?
That was Heard on the Street.
Okay, I thought there was something with the herd, but okay.
I think it's Heard on the Street. Anyway.
Oh, that's right. You're right.
Yeah,
Heard on the Street. Yeah.
So attached to mine is not now a subscription, but it's actually, there's a lot more behind it. So we do quite a lot of consulting for hedge funds, mutual funds, some C-suites, a couple of sovereign wealth funds, and we have a shadow business that actually also runs money. So one of my partners, Tracy Schuchart, she runs a family office exposure to energy, basically oil and gas. And we've got quite a few guest contributors, one of whom is Patrick Perrett-Green, who's really a top quality rate specialist, whom I got to know when I was at Brevin.
Joseph Wang was on here.
Joseph Wang was on here. That's right. I like Joseph enormously because sometimes, for example, Zoltan Pozar's got a lot of publicity lately. I can't say I agree with very much with what he says. And I just like to have someone that's been at the front line within the organization, within the Fed, because that's where you're going to hear the plumbing. How does the plumbing work? How does the plumbing affect global markets? So on and so forth. And I think that gets lost in a lot of, shall we say, the meme conversations that you would see on Twitter. So I'm much more interested in what really happens. I mean, there's no doubt we upset people occasionally, but we just
let's try that now.
Yeah. No.
What are you looking for from the Fed today? And is most of this, whatever they're going to say, priced in, or they have the S&P right on the cliff at 4,100. If we take out that low, to me, that we put in Monday, there's a lot of space underneath the market.
Oh, yeah. Well, my thought process on the Fed has been the same. Well, it's been the same since GFC. I don't trust them. Okay. I think they're prone to policy errors. I think the ECB is prone to way more policy errors. The Bank of England is trying to get away from policy errors, and not quite sure what error the Bank of Japan's committed, but they've definitely committed some. But the thing is, so when I look at the ECB, for example, the Fed, for example, right now, I'm very much a traditionalist when it comes to central bank and monetary policy. So I'm always quoting Bagehot. And I'm thinking that, we're going to find out. I listened to your earlier conversations with your colleagues, and this idea of a U-turn on the Fed on first signs of economic weakness. I suspect that's probably right. Now, I don't know whether it's a U-turn or a stop
or a pause. How about the word pause?
Exactly. So my thought process on the Fed is, and this is where I disagree with one of your colleagues on the non-farm payroll and unemployment data. For the last year, I've not been watching non-farm payroll. We knew what was going to happen. We knew it was information that was extremely distorted. Yeah. But I'm watching the wages, and I'm watching the unemployment rate. The Fed watches the unemployment rate. And we're in a situation now where we have high inflation, increasing wages, increasing
labor shortage.
And a labor shortage, increasing trade unionization. And I think that's key. Okay. Because for stagflation, you need wage inflation, right? Uh-huh. And so I'm watching that, because my thought process in terms of the market, and that's why I put the Treasury market page up on Bloomberg, is I actually think yield curve steepening. I've got a 20% position in yield curve steepening. I'm not fully exposed yet.
The Great Steepening.
It will happen. It's inevitable. It's going to happen. And I tell you why. Either we go into, they don't manufacture a soft landing, which is going to be really tough given extraneous factors as well. But just within the US economy, I think it's, they're praying that they can. And I don't think praying is a good policy decision. So if we don't get a soft landing, we actually move into recession with inflation. But all recessions, you see the yield curve steepen. Okay. It's a historical fact. Now, what if this Fed decides pause or stop and reverse? That means they're giving up the fight against inflation, which is getting stickier and stickier. And I'll get back to that in a second. If they're giving up the fight against inflation, then the yield curve, the long end of the yield curve, should see higher rates, definitively against the short end, yield curve steepening.
Right.
And then, in our work with Joseph, the assessment, and I think he's absolutely right, of QT will also lead to yield curve steepening. Coupons to go. So to me, yield curve steepening is inevitable, and it's all a matter of timing. Now, I actually did this at the beginning of April, put 20% on. Was really tempted to put some more on. And it's still in the money. And I just think that's the trade. It's hard. My view is that the long end will go north of 3%. I just am convinced that this Fed, central banking seems to have changed. People are not willing to accept the idea of 2 quarters negative growth to slow down inflation. People have forgotten how destructive inflation is to the economy and people participating in the economy, particularly lower and middle class. And if you want an extreme, just go to Europe. I know for a fact on the ground, this will be a very unpopular statement to make, but on the fact, on the ground, if you go to somewhere like Portugal or Spain, they're all wondering why they're going to be banning Russian oil and gas because of Ukraine. Their view is, and this is, just people in the street, and I've got friends who work in the business in both countries. The people's view on the street is, why are we paying much higher energy and food costs because of the Ukraine? What does Ukraine mean to us? So I think that's a display of inflation is destructive. It is a regressive tax on everybody, but particularly on the lower and middle income families. And it's the same in the US. I was already an inflationista before the war started, because obviously supply chains were severely disruptive. And by the way, I think what's going on in China right now with the lockdowns, why are people saying we may have peaked in inflation, but we ain't going down? The supply chains are being this, if you look at the ships outside of the Chinese ports, it's enormous. Well, that will feed through eventually. And you've now got the semiconductor industry, where back in 2020, everybody was saying, well, it'll be, supplies will be normalized by 2021. The latest forecast is not before 2024. You've got Maersk warning about stagflation and also the supply chain situation in China. So I'm not sure. I think some of these, yes, we've got great comparables, but I think some of the underlying inflation problems will just continue. And people forget that the boost in energy prices, that has a lag of 6 months before it starts to feed through to the consumer level.
Okay.
In terms
and Fed policy too, Nick?
Yeah. So I just wonder, my fear is that the policy mistake I worry about is the Fed is not prepared to be tough enough and let the economy have a recessionary dip to quell the inflation. You've got to have demand destruction. And then if we're worried about stagflation, the big variable in stagflation will be wages. And if we're seeing increased unionization in the US, well, that's not a positive. That's not a positive for the wage inflationary outlook. That's a negative. These unions
you see this 20-year TLT chart.
Yeah.
People have been talking about it for years, and I think it was Luke Roman said that the one thing that people might be missing is that perhaps we're in a sovereign debt crisis. Do you think? This chart, you would think that there's going to be some type of decent rally, but it measures 90 on TLT. So, are we in a sovereign debt crisis here in the U.S. and globally? Because the Fed has really been the main buyer of treasuries.
No, I don't think so.
Okay.
Again, with regard to Luke, I disagree about the dollar. I think.
Okay. So you still think higher dollar, and this is part of the squeeze.
Well, potentially higher dollar, yes, particularly against the yen. If you pull up the dollar yen chart, you can see it, and you go back. I think I did a monthly chart, so you've got to go for a longer history. There's a reverse head and shoulders.
Okay, yeah, and that's with the right shoulder.
Right.
Yeah, and it measures like 150 or something, doesn't it?
170.
Okay. Yeah. That's sharply higher yields.
Yeah, exactly. And the thing about the dollar is, I've been on various. Actually, I was on the main Middle Eastern channel with instantaneous translation, which is always fun to see it afterwards. And it was an hour's program discussing the dollar as a reserve currency. And there was myself, and then there was a chap from Beirut who was very much of my view. And then there was a chap from Russia, that was very interesting. And, you could see all the three faces on the panel because we were all virtual. And they kept coming back to me because my eyebrows would shoot off the forehead on certain things that the chap in Russia was saying. The point about the dollar as a reserve currency, who threatens the dollar as reserve currency? People will say the renminbi. In the old days, they used to say the euro. You're talking about the two most mercantilist economies of the world. They love their surpluses. Then you look at China, they love their control. Neither bloc I'll define them as blocks because that's relevant for euro, neither of which are prepared to accept Triffin's dilemma. You got to run a current account deficit. You got to have a free float. That's completely anathema to both the Chinese and the European Union, i.e. Germany.
So you think Israel has it wrong reducing dollar holdings? That's
No, of course you're going to have to. You see, my view is, I think actually, I'm very positive. I'll put this out there. Let me put this out there. I'm quite positive on an Anglo-spheric arrangement, and I would include the yen in that in terms of they're very Anglo-sphere adjacent. So, you know, I've noticed that actually, interestingly, sterling has stayed steady. The Aussie dollar is of interest to reserve managers. The Canadian dollar is of interest to reserve managers. There's enough liquidity out there. What you know, when you talk about a sovereign debt crisis for the US, my point is, if you accept that the US dollar prevails in terms of liquidity, and remember, vis-a-vis the dollar, you have the euro dollar market.
Yes.
There's nothing equivalent to the euro dollar market from any of the other currencies.
Bigger, yeah, that's
right.
right.
Why did one of your colleagues talk about dollar shortage in Europe being problematic? It is, right? So, you know, that's why you have the Fed swap lines. And people say, well, the US has weaponized the dollar. The dollar was always a weapon.
Yes.
1970.
Hegemony was enforced.
Exactly. The British
differently.
Exactly right. So there's a history of it being weaponized. It's always been a weapon. But the point is, people have got to put their money somewhere. And that somewhere has to be liquid. So I don't think there's a sovereign debt crisis involving the US. I think yields could go higher. And I do have a solution for all, you know, all these Anglo-spheric central banks. And
the debt jubilee.
Exactly. And it would exclude the ECB, of course, because they can't do that. But if you think about debt jubilee, it's just cancelling two sides of what is de facto the same balance sheet.
Right.
It's the same balance sheet, if you think about it. Now, what are the consequence that would worry me about a debt jubilee? Because that's, you know, that's the way I look at the debt situation. But the thing that worries me about the debt jubilee is if you had it, you know, can you imagine what certain governments would do suddenly with oh, look, our balance sheet has been cleaned up. We've got a lot of fiscal room. And that's where the inflation comes from as well. People are, you know, looking for reasons as to why inflation is so high in the US and everywhere else. Fiscal.
Yeah.
You know, I'm quite monetarist in that sense. You know, my piece yesterday was the inner Milton Friedman in me. Fiscal has been problematic for inflation. There's two problems that occurred, I think, in the US. The Fed carried on adding liquidity until recently. They didn't need to. They should have stopped last year. And that last fiscal boost was just too big.
You and Larry Summers.
Yeah, amazingly, I agree with Larry. It's been a rare event, but I find myself agreeing with him more and more. So my concern with the Fed, I think I doubt whether today's meeting, unless there's real meat to the QT, quantitative tightening announcement.
Right.
I doubt if today's meeting will be a hawkish surprise. And I think he will maybe not push back. If somebody's going to ask him about 75 basis point rate hike, you know, with 60% market discounting that for the next meeting after this. But I doubt that. I think he will sort of say, well, that's not really on the table. We haven't discussed that yet. And that may be the thing that triggers a short covering rally. And, you know, even if we get up to 4,300 or 4,500, bear markets have horrendous rallies if you're short. And I mean, I can certainly see a reason for the market having a rally. a rally. But there was one comment I wanted to make, and somebody mentioned ARK in your chat
ARK,
before.
yes.
Okay.
Yeah.
ARK is your archetypal, excuse the pun,
Okay.
retail stock, isn't it? Retail ETF. It's retail. And if you look at the shares outstanding in ARK versus the price decline, retail hasn't sold. And I suspect that's the case. From what I'm hearing is that's the case across the markets.
Oh, they're still following her around and wanting
Yeah.
to take selfies with her
Exactly.
at Bitcoin conferences.
Exactly. So
You'll know they sold when they show up with pitchforks and cattle prods.
Yes, exactly.
Right, buddy? Then you'll know.
Dale, I so agree with you on that one. But I think it's a good indicator. It's something worth watching in terms of what's retail doing. You know, and there's what we try and do in this site, and what we try and do in our consulting work is bring everything back within the cognitive threshold, because there's so much cognitive dissonance out there and nonsense. The fundamentals are not, if you've done, if you do your work and your research, you can get to your fundamental positions, pull yourself back from all the noise out there. And, noise has just increased exponentially, particularly with social media. And our aim is to say, look, particularly over this year, I mean, we got bearish NASDAQ right at the end of last year, and we started to get short NASDAQ and some of the tech stocks for the inflation, for the bond market, so on and so forth. And the rationale behind that was these rates can't go lower. These rates in the US have to go higher, right? Now where that feeds through over, for example, to Europe, and where there's differences there, is one, the ECB is not the lender of last resort. It's not a Baghotian central bank. They're caught between a rock and a hard place. The rock is inflation, and the Germans are going crazy, but so is actually on the ground now. I think a lot of Europe's going crazy. Watch the wage claim. I think IG Metall was 8.5% was the wage claim they've just put in. Even the ECB's staff union put in a wage claim for 5.5%. That told me something. They have these
10-year. I mean, if we rallied the 10-year back again one more time towards 3, you were talking about 3.25. To me, this is starting to not confirm new highs, and that's usually a sign of not to short them, but at least not be.
Well, that's why I'm talking
bullish
on the yield curve, because if it doesn't go higher, that means the short end's suddenly adjusted to a different expectation,
like back to 240 or so.
Yeah, I mean, that's possible. That's entirely possible. I don't think it's justified.
Yeah.
And I think, I'm waiting for some of the wage pressure to start shaking.
So your highest conviction trade is plain the Great Steepening.
I just think I can't see how it doesn't. If you look at you've got quantitative tightening, but if you look at the two alternatives, we go into a recession. The Fed gets, I think the odds of a soft landing are much lower than the odds of creating a recession. How deep the recession will be, who knows? So if you go into a recession, historically, a recession always has yield curve steepening. Now, if the Fed stops, and particularly if they U-turn, you're going to have yield curve steepening again, because they've given up the fight against inflation.
Yeah, I think it's going to take a lot more S&P damage for them to U-turn.
I agree with you. And actually, I think in terms of the S&P and the Fed, I said this at the beginning of the year. For the last 40 years, but particularly since the GFC, the Fed's job was suppressing volatility.
Yeah.
Which was good for the S&P, clearly, as was the liquidity injected. We're now in a situation because we're in a deflationary world. We're not in a deflationary world anymore. We're in an inflationary world where just-in-time inventory control no longer works. It's got to be just in case, and that, by implication, is higher inflation. But so if we assume we're now in an inflationary world, they can't suppress volatility. It's just impossible. They've got to
Great
reverse.
news for VIX traders and FX traders.
Well, can I say something on the VIX? I've had this disagreement with somebody for a while. I think The VIX, we at Brevenhard, we had a visit from the originators of the VIX ETF, and they said to us, "Do you?" I think I was one of a few people. They said, "Do you trade the VIX?" And I turned around and said, "Well, I used to until you did the ETF." So when I talk about market volatility, I'm actually looking at broad market volatility. If you look at the volatility, if you look at the move index in bonds, remember bonds is the oil that feeds the engine. Okay, that is surged higher, and it's not coming down. You look at FX vol. Just look at dollar yen or dollar renminbi or euro yen vol, 1 year vol. These are really very extended on the high side. I have always looked at FX vol as a lead indicator for something breaking somewhere when it starts to spike.
Okay, well, so I mean, this was a monster move in yen, and it's turned into a pretty good monster move. A dollar rallied a lot further than I thought it would. And there's still people looking for higher. You're probably one of them, 107, 110.
Well, I originally, way back when we were around 92, we made a call for 104. So we haven't been far away.
Okay.
Yeah.
So we're there.
Yeah, well, I'm not.
Almost.
We're almost there. And my view on the Fed is the first reaction today will probably be the wrong reaction.
Yeah.
Much more.
Love that action.
Yeah. I just want to hear what he says. And then, he can say certain things. Then we've got a slew of Fed speakers coming out thereafter. We have to listen to what they're saying. We have to be convinced they're so behind the curve. That's where I agree with Mohammed El-Arian. They are so far behind the curve. There is a credibility issue. And if you look around the world where there's been credibility issues, Reserve Bank of Australia is a good example. And their bond market yield curve control got defeated by the markets. And yesterday they raised rates 1/4 point.
Yeah.
Whereas it was 50-50, 15 basis points or nothing. Now we know that the central banks all speak once a month via the BIS. We've seen hawkish from Canada, hawkish from Australia, hawkish noises coming out of New Zealand. Bank of England would like to be more hawkish, but there are issues with the economy there right now, which obviously, because of what's going on with Ukraine and Europe. I think if that's an indicator of what the Fed's going to do, we should expect hawkish. But I find it difficult to think that.
And hawkish in terms, and let's wrap it with this, hawkish in terms of QT and the timing and amount. That's what we should
I think Powell, to be hawkish, I think Powell will not rule out anything in the presser vis-a-vis questions.
Okay.
That is where I have my doubts today. I think he may say we haven't discussed 75 basis points.
Well, I'm going to send a DM to Pedro da Costa and have him hammer Jay today until he gets an answer.
That would be fantastic. Fantastic.
Nicholas, really a pleasure meeting you. And looks like, guys, some excellent content here as I've been scrolling through Nick's.
We have a weekly free on Sunday.
Oh, okay.
Which is called The Week That Was, The Week Ahead, where I just take highlights from everything and just give people a taste of what mattered to people, our subscribers, and also because the interesting thing is what we're trying to do is bring institutional thought process
to risk management to the
that's
the
what
little
the site's
people.
for. Yeah,
you're bringing like real high-end, highbrow research to.
That's what we're trying to do.
The surf
in a way that can be understood. We can do the complex stuff with our consulting clients, right? But we want to make it understood because we're in a high risk environment right now.
Yeah.
And people have got to watch out for that banana skin that sits there around every street corner, ready to trip you up, slip you up.
Well, if they've been in this business, they're aware that the waters are filled with barracudas and sharks.
Exactly. That's exactly.
All right, so everyone be careful by the shore. Nicholas Glinsman, you could follow him also on Twitter at @nglisman, and check out intelligencequarterly.com. Shy Girl does his commodity stuff, and
Exactly.
we'll do this again down the road.
I would
Nicholas.
love
What do you
to.
think?
I would love
Huh?
to. Absolutely.
Okay.
We'll get
Okay,
it. We'll
in
get
the road.
aggressive we'll get aggressive in terms of interaction. How's that, Dale?
Okay. Peace, and you're now my trading warrior brother. So, most of my best friends in grade school, we fought on the playground first. So, rite of passage for a little boy. So, thank you, Nick. It was great meeting you.
Likewise, Dale, and have a
Good
good
luck
day.
today.
Good luck to everybody out there.
All right. Adios.
Okay. Adios.
All right. So, everyone, that's a wrap. Good luck today on the Fed. Remember, don't try and predict it. React to it. And we'll see everyone tomorrow. And good luck the rest of the day. You're very welcome. And thanks again, Nicholas Glinsman, for edifying the community today. Adios, everyone. And join the team in now 10 minutes for the morning edge. See you later.